Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Energy Fuels stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Energy Fuels is the leading U.S. producer of uranium. The company is headquartered in Lakewood, Colorado, and was founded in 1987. It went public in '88 and trades on the TSX, New York Stock Exchange, London Stock Exchange, and Deutsche Börse. Uranium provides us with nuclear fuel used to generate electricity in nuclear power plants. It's also used for nuclear weapons. The company's current inventory is 691,000 pounds of uranium and 1.7 million pounds of vanadium. Vanadium is used in nuclear reactors. The company had the highest uranium production in the US the past 4 years. It has uranium production facilities in Utah, Wyoming, and Texas, with a combined capacity of more than any other US company. In December of last year, the US government signed a bill to create a $75 million uranium reserve, which means the US government will probably buy uranium from this company in 2021. Let's get started with the model. This is a small cap company. 832 million market cap. They're trading at $5.86 a share, and they have 142 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's also negative every year. Revenue is the sales for the company, and that peaked in 2018 at 32 million. It's down to 2 million in 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue, and the difference is the gross profit. And their gross profit was 1.7 million in 2020, the lowest in the past 4 years. Below that is operating expenses, then below that is operating income, and they have negative operating income every year. They paid under $1 million of interest on their debt in 2020. That's the lowest in the past 4 years. Then the bottom line of the income statement is their net income, which is negative every year. In 2020, the company had no sales in uranium and vanadium. The reason is because the prices of those commodities are so low, the company's waiting for the prices to increase. You can see back in 2007, 2008, it was well over $100 for uranium. Then it dipped to below $20 at one point. It's coming up, but it's still below $40. The CEO said it in an interview, it has to be above $40 for them to make money. This chart shows the price of vanadium, and that's also down quite a bit. When the prices finally increase, this company can unload all its inventory and make a nice profit. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. They have minimal amounts in CapEx each year. Operating cash flow minus CapEx gives you your free cash flow. So they have negative free cash flow each year. So they issued debt to run their business. They issued 14 million in 2017, 32 million, 20 million, and 52 million. Every time a company issues capital stock, it increases the shares outstanding, making your shares less valuable. You can see they're paying down their debt each year. So at the end of 2020, they're pretty much debt free. Let's look at the capital structure. 154 million of equity, 1 million of debt. So they're 100% equity, 0% debt. Their net debt is negative 22 million, and their WACC is 7.72%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.1 billion. We divide that by 142 million shares. And we get a calculated stock price of $7.76. They're trading at $5.86, so they're trading at a 24% discount. It's a buy according to the model. The profitability of this company is really determined on the prices of uranium and vanadium. It's expected that the prices will increase and they'll break even in 2021 or 2022. Then they'll start generating a lot of profit. Simply Wall Street values the company at $397, so they're saying it's overvalued. 4 analysts priced this stock. The average price target was $668, the low was $625, the high was $730. This is the stock price the last 5 years, so it's pretty flat for a while, but the price has really been driven up the last few months. Their beta is 1.46, so the stock moves 1.5 times the market. In the past 52 weeks, the stock has gone up 273%, while the S&P 500 went up 46%. The 52-week low was 138, the high was 783. And the stock is trading above its 50-day and 200-day moving average. About 4 to 5 million shares are traded each day on this stock. Of the 142 million shares outstanding, 139 million are on float, 24% are held by institutions, and about 13% of the shares on float are shorted. In the past year, 3 years, and 5 years, this stock has outperformed its industry and the market. Analysts are forecasting their earnings to grow 101%, its industry 20%, and the market 15%. Analysts are forecasting their revenue to grow 102%, its industry 4%, and the market 9%. In the past 5 years, their annual earnings grew 25%, while its industry grew 4% and the market grew 12%. In the last year, their earnings grew 27%, its industry decreased 36%, and the market increased 17%. If you invested $10,000 into this company 10 years ago, you'd be at $2,600 today. That's a 74% loss. The biggest shareholders, BlackRock at 5.3%, then Old West, Vanguard, Murray Asset, and State Street. Let's look at their financial ratios. The average PE in the market is 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Their price to sales ratio is 501, so investors are paying $501 for $1 revenue. Price to book is 5.4, which is between the median and average. They have negative EBIT, so they have negative return on invested capital. Also negative interest coverage ratio. Negative ROE. Their current ratio is 4.3, so they can easily cover their current liabilities with their current assets. Their current assets are $22 million of cash and $27 million of inventory. The company does seem to have enough capital to get through the next 12 months without taking on any debt or equity. They had negative $33 million of cash flow and $40 million of working capital, so they have $7 million of funding. The best way to look at ratios to compare them to companies in the same industry. I've done 2 other videos on uranium companies, and Energy Fuels is right here. If they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're pretty much worse in every category except debt. They have no debt. The other companies have a little debt. So to summarize, I have them trading at a 24% discount. Uranium is a really clean and efficient commodity. The success of this company is really dependent on the prices of uranium and vanadium. They're able to generate a lot of those commodities, but they can't sell them until the price hits a certain point. I rank their free cash flows, revenue, and ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below.